can do. So, Charles, are you there? Charles, are you there? All right. So we don't have Charles. Someone should do the reading for us now. All right. Question number one.
Okay.
Go.
Question one.
Yes, yeah.
The principal spending officer of your department believes that the department should be able to change its accounting policies as often as possible to reflect the changing dynamics of public administration. He therefore directed the Director of Finance to change the accounting policy to help the department manage the information that goes out to the skeptical stakeholders. Required. A. In line with the public financial management, explain to the principal spending officer how accounting policies are made in the public sector, indicating clear whether the department has the authority to make accounting policy. B. In reference to IPSAS 3, accounting policies, changes in accounting estimates and errors, discuss the circumstances under which accounting policies can be changed. And then C. Explain how the change in accounting policy should be accounted for in line with IPSAS. Thank you.
All right. So thank you, Senior. Yeah. So this is the issue that your principal spending officer is saying that the the department can change its accounting policy as often as to reflect. So you have the capacity to change your accounting policy and the director of finance to change the accounting policy. Okay, this one they are asking you in line with the Public Financial Management Act. This one is not about the IPSAS. Okay, in line with the Public Financial Management Act or in line with the Public Financial Management, it should be the Act. Explain to the principal spending officer how accounting policies are made in the public sector, indicating clearly whether the department has the authority to make what accounting policies. If you come to the provisions of the Public Financial Management Act, how is what accounting policies how is accounting policies being made in the public sector? Who is responsible for making accounting policies? If you come to the Public Financial Management, not under the IPSAS. Okay, the IPSAS you can only make a change when the change is required by the standard, or you are saying that this particular change is going to provide relevant and reliable information to the users. But this one they are talking about in line with the Public Financial Management, most especially to the act, who is responsible for changing accounting policies or making accounting policies in the public sector. How do you go about the first one? All right. How is accounting policies made in the public sector in line with public financial management? Who is responsible for making accounting policies in the public sector?
So, controller and accountant general in consultation with auditor general.
So so is it that you don't know how to go about a question, or you don't know what that is what you are coming to say? Yeah, is it that you don't know that will be the answer, or you don't know how to put it?
You see, you earlier said that not the one that's under the EFSA. I'm sure
Yes.
that is.
So you don't have to talk, you don't have to come and talk. They are not saying that in line with what IPSAS. They are saying in what? In line with the public financial management. Okay, in line with public financial management. Okay. Explain to the public spending officer how accounting policies are made in the public sector, indicating clearly what. Okay, indicating clearly whether the department has the authority to make what accounting policies. I'm waiting, seniors. Seniors, I'm waiting for the A part.
Say the question again.
So the question is here, in line with the public financial management, explain to the principal spending officer how accounting policies are made in the public sector, indicating clearly whether the department has authority to make accounting policy.
Okay, so I will start by explaining accounting policies, and I can say that accounting policies that are specific principles, convention, and rules applied by an entity in preparing and presenting financial statements. Then I will explain the scope and the standard. This standard set out the accounting policy as by applying the changes in the accounting policies, the changes in estimates, and correction of prior period errors.
All right. Yeah, at least you have made an attempt. Okay. Yeah. How is accounting policies? How do we make accounting policies in the public sector? Okay. Accounting policy itself, we are coming to look at, okay, going forward, how do we account for certain transactions? So if the controller and accountant general is saying that all our PPs are going to be measured at historical cost, that is an accounting policy. But this person cannot just turn up and make accounting policy. So what are you coming to say? Okay. When you want to make an accounting policy, what is the first thing that you have to do? When you have to make accounting
Hello,
policy.
sir.
Yes, please.
You check whether they prepare their financial statement in accordance with the IPSAS.
Okay, so in this case, let's assume that this is about public sector in Ghana. They are now adopting the IPSAS. So they are preparing the financial statement in accordance with IPSAS.
Okay, so if they prepare in accordance with IPSAS, you check if there is any IPSAS which deals with the transaction, like the PPEs, which shows how they should record it.
Okay. 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 If there's no specific standard relating to that particular transaction, what do you have to do?
They have to use their own description to select an accounting policy to deal with the transaction.
So in this case, who will be exercising his or her description?
Management.
No, this is the principal spending officer.
Principal spending officer.
The principal spending officer or director of finance cannot do that. No. We have an authority who is responsible for developing accounting policies for all the public sector entities.
Controller and accountant.
Yes. So the controller and accountant general will now exercise his description to develop an accounting policy, and that will be issued to the public sector entity. So let me put something over here for you. Okay. So we are now adopting IPSAS. Okay. So this is just telling you developing and selection of accounting policy. Okay. So if you come to so like we look at the A over here, developing and selecting accounting policy. Okay, the accounting policy you are going to be using is just the assumption or the concept that you are going to be using to prepare your financial statements. So if you come to developing or making of accounting policy, what you have to do is, okay, the controller and accountant general, if he wants to develop an accounting policy, he will not just stand up and develop accounting policy, because the statement that the public sector entities are going to be preparing is going to be used for what? For decision making. So it has to conform with what? Other regulatory what? Requirements. So what the accountant and controller general will do. Okay. In the public sector, according to the Public Financial Management Act, we have only one person who is responsible for developing and issuing what accounting policies and accounting manual to the public sector entities. And that person is the controller and accountant general. If the controller and accountant general want to develop accounting policy, okay, he or she will do one and two what things. The first thing that the controller accountant general will do is that he will check. He will check to check to see if there is what, if there is a specific what, if there is a specific IPSA, okay, if there is specific IPSA or IPSAS relating to what, relating to the treatment, relating to the treatment of the item or the transaction. So to make an accounting or to make or develop an accounting policy, the person responsible according to the Public Financial Management Act, that is the controller and accountant general. The controller accountant general, if the controller and accountant general want to make accounting policy, he or she will check to see if there is any specific what, IPSA or IPSAS relating to what, the treatment of the item or the transaction that is happening. So if it's an intangible asset, if they are buying a software, the software fall under intangible asset. So they have to use IPSA 31 to account for what, that particular one. Okay. So if there is any specific one, if he or she will check whether if there is any specific what, IPSA relating to that, then if you want to develop the accounting policy, you will develop the accounting policy now under the provisions of what, that particular IPSA. Okay, so he will now be saying that, okay, PP, IPSA 17 is saying that if you purchase PP, you can decide to measure the PP at cost or measure it at what, at fair value. So in that case, we are now going to be measuring our PP using what, revaluation model. So he is now developing the accounting policy from the provisions of the what, the existing accounting policy that is talking about that particular what, that particular treatment. But where there is no accounting policy, what will happen? Where there is no what, where there is no specific IPSA or IPSAS dealing with the treatment of the item or the transaction, what will happen? If there is no specific IPSAS dealing with the treatment of the item or the transaction, what will happen?
Management should use their discretion.
And who will be the management here? Is it going to be the director of finance or the principal spending officer?
The principal spending officer should use his discretion.
What are the duties of the principal spending officer? The principal
is responsible for the expenses of the department.
The principal spending officer is what? Is serving in public sector. Who has the mandate? Who has the mandate for making accounting policies to, or who has the mandate to making accounting policy for the public sector entity?
Controller and Accountant General.
Yes. So over here, the controller accountant general will exercise what his or her judgment to develop an accounting policy that will now be issued to the what, to the public sector entities. So don't over here, the management will now be the what, the controller and accountant general. He has the mandate to develop accounting policies to all public sector entities. So when there is no specific accounting policy, the controller and accountant general, okay, the controller and accountant general, okay, or the principal spending officer can contact the controller accountant general and say, this is the problem that we are having. So he will say, oh, go about it like this, and we come and do something about it. So the item, so the controller and accountant general. I hope that is the abbreviation. CA.
Yes, sir.
Okay. Controller accountant general to exercise his or her. Is it his or her?
His or her personal judgment.
But the controller accountant general itself, is it a man or a woman?
I think for now
It's a man
it's
now.
a man. It's a man now, yes.
Okay.
His name is Kwesi.
Okay. For me, for the current issues, I'm not on top of the current issues. I have nothing to do with those ones. So his or her professional judgment to develop to develop an accounting policy making references to
Recent pronouncements and publications.
Okay, so recent pronouncements made by other standard setting bodies. But again, there's one important thing that he or she must make reference to.
The conceptual framework.
Exactly. So that is a guideline issued by the board itself. So make reference to the conceptual framework, taking into consideration the definitions. Okay, taking into consideration the definitions, measurements, basis, recognition criteria, set out and other
events.
Okay, and other events set out in the conceptual framework. Okay, so it can also make reference to the best industry practice. Okay, the industry. So the industry, what they do if some transactions like this happen, what is the best practice? It can also make reference to this one. Okay, so indirectly, the question that they are asking you is how is accounting? Yes, yeah.
Senior, please. So here is it taking into consideration the what?
Taking into consideration the definitions, measurement basis, recognition criteria, and other events set out in the conceptual framework. So if you take the conceptual framework, we can see that we have definitions of asset and all those things. We have the measurement basis of an asset, and we also have the recognition criteria for those elements.
All right, thank you.
Okay. So indirectly, they are just asking you how accounting policy is being developed, or how should select and apply what, or how to develop an accounting policy. That is a question that they are asking you indirectly. Okay, so this is a question that they are asking you indirectly by the Financial Management Act. So if you want to develop an accounting policy, it is the Controller and Accountant General that is responsible. One of his statutory responsibilities to develop accounting policies and also issue accounting manuals to the public sector entities. So he has the mandate to develop the accounting policy. If he or she wants to develop an accounting policy as set out in the public financial management, what are the things that will be followed to develop an accounting policy? So what we can't just stand up and say we are developing an accounting policy. It means that a certain event has happened and we want to know, or we want to prescribe what the treatment for that particular item. That is when we develop an accounting policy. So developing this accounting policy, the person cannot just stand up and say he is going to be what? Developing accounting policy. That is why the controller accountant general must be a member of a professional body. But I don't know whether he's a member of a professional body, or I don't know, because I don't even know the person. I don't even know anything about the person. Okay, so this person will now what? Use the provisions of whatever standard the person is coming to, or whatever accounting policy that the person is coming to develop. So the controller accountant general will check to see whether there is any accounting policy or accounting standard dealing with this particular situation. If there's any, then he would develop accounting policy now in line with what the provisions of such IPSAF. But if there's none, he is going to be using his professional judgment now to make an accounting policy, not just to just sit in your office and make accounting policy. You make accounting policies and use basis to support whenever they ask you. You say you have developed this accounting policy, taking into consideration, okay, what has been said by by treatment of these items in the private sector. So this is what the accounting, the International Financial Reporting Accounting Standard Board is saying. So they are saying that if these issues happen like this, they are treating it in the private sector. So that's why I also developed this accounting policy, taking into consideration their interpretation and also their guidelines. If you are not doing that, I have developed this accounting policy, taking into consideration the conceptual framework. The conceptual framework defines an asset like this. So looking at this particular transaction meets the definition of an asset. So therefore, we are classifying it as an asset. So you don't just stand up to us. You don't just have to stand up and say that no. So they are just indirectly, they are just asking you how accounting policy is being developed, or how accounting policies are being made in the public sector. So use the issues, these are the words you are going to be using to answer the question. All right.
Sir,
Yes, please.
can the requirement of IPSAS related and similar issues be counted when the management are making their judgment?
When the similar issues like
Please, did you get my question?
No, please.
Hello.
I didn't get your question, Sina.
Yeah, please. I said when in the absence of IPSAS, can management also consider the requirement of IPSAS related and similar issues?
IPSAS related and similar issues, how?
Like similar entity facing the same issue, but they already apply IPSAS in that entity. Can it be possible for the management to apply?
If there's an IPSAS relating to that, they don't have to use they don't have to use description again. They'll just go by what the IPSAS is saying.
Okay.
Okay. So if those people are applying IPSAS, it means that there is an IPSAS relating to that. So we also develop an accounting policy in line with the IPSAS, what the IPSAS is saying. So we say that we are going to be using cost model. Okay, you can see that Ghana, we haven't been using the IPSAS, but you see that most of the public assets are carried at cost model, isn't it? So they developed an accounting policy in line with the IPSAS. So they are using cost model. So since those people are using IPSAS, it means that there is an IPSAS relating to that particular one. So the accounting policy will be developed from the what? From the IPSAS that we have. That is it. I hope that is cool now.
So Tina, so this one is for the A, right?
Yes, please.
Okay. So that is when there is no IPSAS.
If you want to develop an accounting policy, you first of all ask yourself whether there is what, whether there is, now we are adopting the IPSAS, we are implementing the IPSAS fully. That's why you are even doing the IPSAS in the public sector now. Okay. But even if we are not using IPSAS, if you want to develop an accounting policy, you are going to prepare a statement that the people are going to be using to make decisions. So if there is a standard relating to this one now, then we just go and look at the provisions of the standard and develop an accounting policy in line with what the standard is saying. But if there's no standard, it means that we don't have a solid or we don't have a good reference point to make our accounting policy. So we have to come and sit now. We have to come and sit by ourselves now and develop the accounting policy. But if there should be an IPSA, the IPSA will tell you initial recognition of the item is this one. So subsequent recognition is this one. So you can look at what the IPSA is saying and develop your accounting policy because you have a good reference point now. But if there is no IPSAS, it means that you don't know how to initially recognize the item and also subsequently recognize that particular item. So it means that you have to now sit by yourself and now come with an accounting policy. But that particular accounting policy should not be in your room, having your TV in front of you, and you'll be doing things on your own. You still have to make reference to what other things being said by other professional bodies or the conceptual framework itself. So why are you recognizing an item as an asset? We are recognizing as an asset because the conceptual framework is saying that assets are resources owned and controlled by the entity, which feature economic benefits are expected to flow into the entity. So since we own this particular item, and we can actually demonstrate control, and it's going to be giving us some benefits, some form of benefits over the future. That is why we are recognizing this particular one as an asset. And we decide to use cost because the conceptual framework is saying that one of the bases of measuring or determining value of an asset is to use historical cost. That's why we are carrying the asset as historical cost. That is it.
All right, thank you, Senior.
Okay. Yeah, in reference to IPSA 3, accounting policies, changes in accounting estimate and errors, discuss the circumstances under which accounting policies can be changed. So what are the circumstances that accounting policy can be changed according to the IPSA 3?
Yeah, when it is required by IPSAS to do the change.
Okay. To changing accounting policy. To changing accounting policy. So when the change is required by what? When the change is required by the IPSAS or by the standard. Okay. Now, what is the current IPSA we have now? I'm sure that will be IPSA 45 or something. They are having IPSA for, they are now trying to have IPSA for non-current asset head for sale and discontinued operation. So I'm sure that is 45 or, okay, they are even trying to take off the 17. They are bringing 44 or 43. I don't know. Okay, those all will be effective from maybe 2027 or some of them 2026. Okay. So sometimes the change will be required by the what? By the IPSA, like how we have the IFRS 16. First, it was IA 17, which is the leases. Now they are now changing it to what? We are now using the IFRS 16. So if the change is required by a new standard, it means that you have to now change how you account for those terms. Okay, those days there was no issue of what leasing accounting in the IA 17. So if you are treating all your lease rentals as an expense, now the standard is saying that you should now what find the present value of all those amounts and now recognize it as what as a lease liability and right of use. So what you have been doing first, you have to change from it. So you're not changing your accounting policy. That particular change is required by the standard. So if the change is required by the standard, it means that you have no say. As far as you are going to be applying the standard, you have to change your what? You have to now do what the standard is saying. So if the change is required by the standard, okay, that one is a compulsory change. You can't do anything about it. The next one is what? The next circumstance is what? We have mentioned only one. The next one is what?
The change will bring irrelevant and reliable information.
Okay. The change is required by standard. The change is required by standard, or management is now convinced that, okay, management is convinced that, management is convinced, management is convinced that the change, when the accounting policy is changed, when the change will result in providing relevant and reliable information to the users. Okay, to the users. So the change is going to provide relevant and reliable information to the users. And if you are providing this particular, if you are changing the accounting policy, which is a voluntary one, okay, accounting policy can be what? Can be a compulsory change, which is required by the IPSAS. You can also change your accounting policy voluntarily. But when can you do this? When you are convinced that the change is going to result in what? In providing more relevant and reliable information about the entity to the what? To the users. So if the accounting policy is being changed, it can provide a meaningful, relevant, and reliable information to the users. And if you are changing this particular accounting policy, you have to take into consideration that this particular policy is going to be providing an information that is faithfully presented, information that is going to be prudent, and information. So we have the principles there. Sometimes they can also ask you about the what? About the principles. If you want to change an accounting policy, what are the principles? Okay, so these are the two circumstances under which accounting policy can be changed. The change is required by IPSAS, compulsory change. We can do a voluntary change, but we can only do that when management or when we are convinced that the change is going to provide information better than the information that we were providing before. So the change is going to result in what? Providing more relevant and reliable information to the users. Okay. Those are the two situations that you can change an accounting policy. Okay. C, explain how the change in accounting policy should be accounted for in line with what? IPSAS. Okay. How do we account for? Okay. How do we account for change in what? Change in accounting policy. Okay. So we have the C here. accounting for change in what? Change in accounting policy. How do we account for change in accounting policy?
Retrospective application.
The retrospective application is for only one of the change. We have having two circumstances. So we have two ways of accounting for the two circumstances. Okay. So the first one, if the change is required, if the change is required by the IPSAS, if the change is required by IPSA, the change in accounting policy, then if the change is required by IPSAS, then the change in accounting policy, the change in the accounting policy, the change in the accounting policy is applied by the, okay, is applied in relation to the transactional, okay, transitional provisions, okay, I will explain transitional provisions, that transitional provisions given by the IPSA, okay. So if you take an accounting policy, you will see that you will see effective dates. If you have seen the full accounting policy, those that have been what? Sharing the full accounting policy with you, you see effective dates over there. Then you see some issue like transition also there. So if we are changing accounting policy, what will happen is that since the people cannot just shoot to the new requirements, the standard is going to be giving them what? A transitional period. What will happen is that you will be applying the two accounting standards. Okay, you'll be applying them. You can still apply the old one small. Then you will now get to the new one now. So they will give you a period where they will allow the old application for some time, and up to that particular time, then they will now take the old one out. This is to help the preparers of the financial statement to be familiar with the provisions of the new accounting standard. So if the change is required by the IPSAS, you apply the accounting policy or the change in relation to, or making provisions, or making references to the transitional provisions made by the IPSAS. So they are going to give you a period, like a grace period, where you'll be familiarizing yourself with the new accounting policy, and they will give you a date that up to this particular date, then the application of the old standard will no longer be accepted. So you have to now move on to the new one. It's just like how when tax laws are being changed, they will give you some transitional period that, okay, you can be applying this one, the other one small. A time will come that the old one will be out of the system. So you apply this particular accounting policy in accordance with the transitional provisions made by the IPSA, if the change is required by the IPSA. But if the change is a voluntary change, the voluntary change is where we are confident that the change is going to provide us with relevant and reliable information. But if the change is voluntary, okay, if the change is voluntary, that's the change is made by management, is not required by the IPSAS. So the change is a voluntary change. So if the change is voluntary, if the change is voluntary, then the change must be must be applied retro. The change must be applied retrospectively. Okay, retrospectively. So the change must be applied retrospectively. So the retrospective application is always for the voluntary change. Okay, but if you also have, if there's no transitional provisions by the standard, so the retrospective what application must also be what must also be applicable there. So if there's no provisions made by the IPSAS, then you can also apply retrospectively. But if there's a provision, you make reference to the provision and apply the accounting policy as such. But if the change, you are just changing the accounting policy, then the change must be applied what retrospectively. Although sometimes the retrospective application will seem to be what impracticable. What do we mean? We are now changing from revaluation to cost model, or we are now changing to cost model to revaluation. But the asset was never revalued before. This is our first time that we are revaluing. So it means that we cannot apply this one retrospectively because there was no revaluation in the past that we have to go and adjust. We are just starting from this year. So we are start applying the new accounting policy in this year. So that is a retrospective, that is the prospective application. The retrospective application is only possible if you have data, you have information to actually go about or go back to to change those issues. If you are now changing from revaluation model to cost model, and we have revalued the asset 2 years ago, and you are now changing to cost model now, what it means is that you have to go to the 2 years ago and assume that you are using cost model as that date, and now correct the revaluation or remove all the impact of the revaluation from that date up to now. But if there was no revaluation first, the first time you have revalued the assets is this year, it means that you're only going to be correcting the entries made for this year, and indirectly you are doing prospective application. Okay, but they are not asking us if the retrospective application is impractical. What do we do? They are just asking us how we apply or how we account for change in accounting policy. If the change is required by standard, we apply the change, taking into consideration the transitional provisions that we are made by or that we are given by the IPSA or the standard. So we apply the accounting policy in relation to that. But if the change is a voluntary one, where we are saying that this particular change is going to be making or is going to be giving us relevant and reliable information, then the change is applied retrospectively. Where the retrospective treatment seems to be impracticable, you either adjust the opening balances or you prospectively apply that particular change. Okay, a very simple issue there. So you don't have to stress yourself. Borrowing costs, IPSA 5. Just, I hope you are in now. Charles, I hope you are in now. Okay, Zina Godwin. Charles is gone, so help us.
All right. IPSAS 5, borrowing cost. On 1st January 2021, the University of Ghana borrowed 30 million Ghana cedis to finance the building of 2 student hostels, both of which were expected to take a year to complete. Construction started on 1st January 2021. The loan facility was drawn on 1st January 2021 and was utilized as follows with the remaining funds invested temporarily. Building 1 and Building 2. So 1st January 2021, we had 5 million for Building 1 and then 10 million for Building 2. On 1st July 2021, we had 5 million for Building 1 and then 10 million for Building 2. The loan interest rate was 30% per annum, and the university could invest surplus funds at 20% per annum. Required. Ignoring compound interest, calculate the borrowing cost which will be capitalized for each of the buildings, and consequently, the cost of each of the buildings as at 31st December 2021.
All right, so this one is just, it looks like a very simple question, but you have to really think through. Okay. The funds that we are drawing down to start the the construction of the building. Is it a specific borrowing or is it a general borrowing?
The specific borrowing.
It's a specific borrowing, isn't it?
Yes, please.
So it means that the funds will not be used elsewhere, isn't it?
Yes.
Okay. So if you are taking 100,000 for construction of your what? Of your building. Okay, maybe you want maybe 2-story building, you want to put up a structure, 2-story building structure there, and you have taken 10,000 from a bank. Please, we can also have a specific borrowing that will be coming from a pool of funds. So we can actually take some amount of money from GCB towards the construction of that particular one. We can actually take some money from ADB, which are all going to be a specific borrowing because we cannot get a full amount at GCB. So we are just taking the amount, but it is going to be specifically for what? For the construction of this particular project. Okay. So if you are giving different funds, not always that it will give you different funds, then it will be general borrowing, unless the question is saying that it is a general borrowing. We can also take money specifically to finance a construction of a particular project from different banks. What it means is that we don't have the money that we need from one of the banks. So we have to now fall on the many alternatives and get the money to finance the construction of this one. Okay. So let's come here. If you are taking 10,000 from GCB towards the construction of your structure, if you use 20, yes, please.
So does it mean if you borrow and you don't use some of the amount to do maybe to invest somewhere, it means that one is a specific one, like you are using all the borrowing for a particular project?
That is it. The amount will not be used in any other project. It will be used for that particular project. You have taken the money for that particular project. That's what we call specific borrowing. It is borrowed specifically for that particular project. It will not be used elsewhere.
Okay. Thank you.
So please, from your example, when you borrow specifically different banks, which interest rate will you apply?
You use the interest rate for each of them.
Thank you.
Okay. I hope that is okay now. And I hope you're okay with that one. So I can move on.
Yes, please. Thank you. Okay. Yes, sir.
All right. So let's come here. So I'm saying that you have taken 10,000 from GCB towards the construction of your 2-story building. You have used 10 cedi out of that money. Are you going to pay interest on only 10 cedis? Are you going to pay interest on only 10 cedis?
No, sir.
No.
You will pay interest on the whole.
You pay the interest on the total amount, isn't it?
Yes, sir.
You pay interest on all the 10,000 that you have taken, isn't it? Okay.
Yes, it is.
That is how the specific borrowing works. Okay. We are taking this particular money to finance the construction of a particular project. The question is, if we are taking this particular money to now buy a car, and we have used only we have taken 10,000, we have used only 8,000 to buy a car, remaining 2,000. We are not going to pay interest on only the 8,000. No, we will pay the interest on the full amount. Although we didn't use the full amount, but the bank will charge interest on the amount that has been given to you. So the specific borrowing, whether you use the full amount or not, what will be the interest that will be going to profit or loss? Now, come over here. You are taking 30 million. It means that you are using 10 million for building A, and you are using 20 million for building 2, isn't it?
Yes.
Okay. Assuming you are not using this particular amount of money to construct building now. what would have been the interest that you'll be taking to profit or loss for this year? You have taken the loan on January 2021. What would have been the interest that you'll be charging to profit or loss?
Yes, 30%.
30% on what?
30 million.
On 30 million,
So it
isn't
will be
it?
9,000.
That would be 9,000. That is
Yes.
the interest that will be taken to what?
Yeah.
The statement of financial performance, isn't it?
Yes.
Okay. So now we are now saying that you are now using this particular amount of money on a particular structure. So instead of you expensing the 9,000, add the 9,000 to what? To the asset that you are using, because the asset is still under construction. So the cost that you are going to be incurring will be seen as what? One of the activities to make the asset ready for what? For use. So instead of you expensing that 9,000, add the 9,000 to the cost of the asset. If the asset is going to be in there for full year, so you just add the 9,000 to what? To the cost of assets. So you can see that we are going to be using what? 10 million on this structure, and we are going to be using 10 million on this structure also. Okay. This particular 10 million is specifically taken to finance the building, the first building, and the 20 million is also specifically taken to what? To finance the what? The construction of the second building. Okay, assuming we are not using this money on the building, how much should have been taken to profit or loss? Although you have given 5 million from January to and this one place, we don't do time apportionment. We don't do time apportionment on specific borrowing unless the building has been completed. And we are looking at, okay, when was the building under construction? This is going to be a full year. So we don't do over here that the first 5 million is going to be taking 1 year, and the second 5 million is going to be taking what? 6 months. No, this is no general borrowing. The money will be used specifically on this project. So you should be taking an interest of what? 30% on the 10 million to profit or loss. So instead of taking it to profit or loss, you now capitalize it. So this is what we do over here. So we now calculate our borrowing cost. So I have the IPSA 5, which is borrowing cost. So I have the interest. So we'll be looking at so many ways of calculating this interest. So I can calculate the interest for each of the buildings by looking at the amount. So I will look at the building 1. You can see that the building is under construction for what? For the full year, isn't it?
Yes, sir.
The loan was taken on 1st January. Construction also starts on that 1st January. So, and we have also incurred borrowing costs on that particular 1st January. Okay, so we have taken the money and we have used the money on the building. So that is going to be the capitalization will start from 1st January. So you can see that okay, so it means that maybe the building has actually been completed. They haven't said anything, or that will take a year to complete. So it means that the building was completed on 31 December 2021. So it means that we have used the money on the asset for a full year. Okay, the building construction was there for a full year. So you calculate the interest. So you come over here, you have 0.3 multiplied by 10 million because we have used 10 million on this particular one. So you have used 10 million on this particular one. What would be the interest relating to the 10 million?
3 million.
Okay, we are having 3 million there. Okay, let's come to the interest also. Interest also, we have building 2. Interest for building 2. That will be 0.3 multiplied by the total amount that went there, 20 million. What are you having?
6 million.
Okay. This particular 6 million, you can also calculate the 6 million like this. You can calculate the 6 million. You can calculate the interest on the full amount that you have taken. It's a specific borrowing. So you take the actual interest that should have been paid. We are talking about if this particular amount of money is not used on a project, how much should have been taken to profit or loss? So instead of you taking that particular amount to profit or loss, add it to the what? Add it to the cost of the building. So we should have taken 9 million to profit or loss for the full year. But since we are using 10 million on one project and 20 million on one project, you will now find what? You will now share the 9 million amount them. So you can find the interest on the full amount. So the interest, so I will be looking at this one alternatively. So you can also find the interest. Okay, so you find the interest on the full amount. You find the interest on the full amount, that will be 0.3 multiplied by 30 million. I'm sure we'll be having 9 million, isn't it?
Yes, sir.
So then this 9 million will be shared in how the money has been used. So that will be 10 over 30 multiplied by 9 million. And that will give you 3 million. Then building 2 as used were 20 million. So 20 over 30 multiplied by 9 million. That will give you 6 million. Okay. So the interest of 9 million that should be taken to profit or loss, 3 million will be added to the cost of building 1 and what? And 6 million will be added to what? The cost of building 2. But there's a very interesting issue here. Okay, they have added certain thing over there. They are saying that the surplus funds will be what?
Invested.
The investor could invest surplus funds at 20% per annum. So you can see that we are going to be using 10 million for the full year. But from January 2021 to 30th June, what happened? We use what? Only 50, we use only 5 million, isn't it?
Yes.
So what will happen to the 5 million as a rational finance director of the university? What are you going to be? Are you going to be keeping it in your locker, or what are you going to be doing?
Invested.
Invested.
So that is what they are saying over there. So if you are doing profit or loss, you'll be getting some investment income. So you'll be getting some investment income from this particular one. So we come here and have investment income. That will be 0.2 multiplied by 5 million,
5 million.
multiplied by 6 over 12. Do you agree?
500.
Yes.
It will be invested for what?
Yes.
0.5.
Okay. That will give us how much?
0.5.
0.5.
Okay, 0.5. So it means that if we should be doing profit or loss, we will be taking interest expense of 3 million and also 0.5 as an income, isn't it?
Yes.
So in actual sense, how much are we charging there?
2.5.
Okay, so the
2.5.
borrowing cost over here is going to be this one. So if you should be doing profit or loss, what you do is that you charge 3 million to profit or loss. But this 3 million, you are not using the full amount. You have invested part of it for what? For 6 months, which is giving you 5 million. So the next interest over there will be 2.5 because we are going to be having income of what? 0.5. That is going to be reducing this one. So our borrowing cost over here to specific borrowing is the actual interest minus any investment income. So what we should have been doing in profit or loss, that is what we are doing over here. The amount that should have been taken to profit or loss, since you are using that amount on the asset now, we don't want you to send it to profit or loss again. Now, come and add that particular figure to the value of the asset. So building 1 will be 3 million. The 3 million minus what? 0.5. What are we getting?
2.5.
Okay. So the cost of the building 1, the cost of the first building, the cost of the building 1. Okay, let's do all of them so that we can do the cost of the buildings as together. Okay, so let's come to the interest income that we are going to be having on the what? On the second building. Interest income. So building 2. That will also be invested for 6 months, isn't it?
Yes.
So you have 0.2 multiplied by 10 multiplied by 6 over 12. I hope that is cool.
Yes, sir.
What are we having?
1.
So that will give us 1 million. So the borrowing cost over here for this one will be the interest relating to them of 6 million minus what? 1 million income. So that the net amount now will be 5 million. Okay, so let's now come to the cost of the building. Okay, the cost of the building. So we have building 1 and we have building 2. So the cost at 31 December. The cost at 31 December. What is the total cost incurred on the building one? At 31
million.
December, that will be 10 million. So that is a cost incurred, that is the amount spent on the project now. So 10 million and 20 million. Okay. Then the borrowing cost for them will be 2.5 and what? And 5 million.
5.
Okay. So we now be having 12.5 and what? And 25. So that is the cost of the building. The cost of the building is the amount that you have spent on the building so far, plus the borrowing cost that will be added to it, to the amount up to the time that they are asking to do this one. Please don't go there and be doing that. Okay. Don't go there and we do that for only general borrowing. That you say that, okay, the borrowing cost for this one will be, the first one will be 0.3 multiplied by 0.3 multiplied by 5 million multiplied by 12 over 12, plus the second one will be 0.3 multiplied by 5 million multiplied by 6 over 12. No. This one, the funds will not be sent anywhere. The funds will not be sent anywhere. You are not sending the funds anywhere. Okay. So you are not sending the funds to any other place. We only do this for the general borrowing. Why? Because the funds are not specifically taken for what? For the project. So what will happen is that the funds will be used somewhere. So where the funds are being used, the interest will be sent to that particular place. So the time that you are bringing the funds over here. So you have the funds for a different project. So you have used the funds on that particular project for 6 months before bringing it over here. So it means that the interest for the what? The whole year will be shared among them because you have used the funds to generate income somewhere. So the 6 months interest should go there. And the remaining 6 months, we are now using it over here. So that remaining 6 months should come here. But if you come to specific borrowing, the funds will not be sent to anywhere where we can send that particular interest to. No. The funds will just be in accounts. But if the funds should be used on a different project, then the interest on that particular, or the interest for that particular period can actually be what? Taken to where the funds are being used. But we are not using the funds on a different what? On a different project. The best thing we can do is what? Is to invest it, is to put it into an account that can give us an interest. We are not going to be using it on a different project. No, we have taken it specifically for this project. But situation where the entity has taken amount of money for a lot of projects. So what will happen is that if we have taken the 30 million for 5 projects, what will mean is that, okay, if you have used 10 million of this one on a 5 project before you send on a project before you bring it to this one, the interest will be shared among those 2 projects. That is why we have been sharing the general borrowing, because the funds will be used on a lot of what? A lot of projects. So that full year, what is the portion? What is the portion? What is the portion of the what? Of the interest that should be apportioned to this particular one, this particular project. That's why we share, we do that time apportion for the general borrowing, because the interest will be shared among so many projects. But this one, the funds will not be sent anywhere. The best thing that you can do is to put it in an account that will give you interest. Whenever you need it, you go and take it. So specifically, all the interest will just be given to the project. That's why we call it specific borrowing. There's no other project to share that particular interest with what? With the project. So all the interest will now be attached to that particular project. So we don't do time apportion. Unless the borrowing cost is incurred for 9 months, that means that even if it's profit or loss, we charge this one to 9 months. Okay, that is the only thing that we do under what? Under so specific borrowing, don't come there and say that the first month is 6 months. The second amount of money is going to be 6 months. The first year will be full year. No, this is not general borrowing. This is specific borrowing. The interest will be paid on the full amount. We don't have any other project to send the interest there. So the full interest for the year will be given to the project. Any investment income will be taken. Any issue with that before we move on to...
Please, can you go to the board? We are just writing.
The board will be shared with you, so don't worry, because we don't have time. By 9, we should be closing. So we have to do...
Sir, please, can you amplify
Your voice more.
This is might be your phone, so you have to increase it because I'm actually talking. All right. Zina Gordon, are you there?
Yes, please.
Okay. So
Yes, sir, I'm there. It's like when someone talks, I can hear it clearly, but when he talks, finding it difficult.
Should I take?
yeah, take the question number 3 for us.
Hello.
I'm only seeing question 1.
No. I've numbered all of them. So maybe can you see revenue from exchange transactions? Question 1.
Yes.
Okay, that's what
Yep.
I'm talking about. Yeah.
Okay. IPSAS 9, revenue from exchange transactions. Question 1. An entity that prepares and presents financial statements under the accrual basis of accounting shall apply IPSAS 9. Revenue from exchange transaction in accounting for revenue arising from sale of goods. Required. State and explain 4 conditions under which revenue from the sale of goods shall be recognized in accordance with IPSAS 9. Revenue from exchange transactions. Thank you.
All right, I'm coming in.
Hello.
Yeah, he said he's coming.
How my screen is you can see now.
Yes, please.
Okay. So what are the 4 conditions under which revenue from sale of goods can be recognized? The 4 conditions.
So one, the amount of revenue can be recognized reliably.
Recognized or
Can be measured reliably.
Okay. So the conditions. Okay. So the conditions for recognizing revenue from sale of goods. The amount of revenue can be measured what?
Reliably.
So amount of revenue can be measured what? Can be measured reliably. Okay. What again?
When it is probable that the revenue can flow, or it is probable that economic benefits or service potential can flow to the entity.
Okay. Probable that what? Future economic benefits associated with what? Associated with the transaction will flow to the entity. Okay. So the transaction will flow to what? To the entity. So the amount of revenue can be measured reliably. What we mean is that you can actually determine the revenue. So you have sold to the person for 10,000. Okay, the revenue is 10,000. But if you are giving something to someone for free, if you are recognizing that as revenue, how much are you going to be attaching to the revenue. So we cannot measure that particular amount reliably. Probable that future economic benefits associated with the transaction will flow to the entity. Okay, what are we talking about over here? You have sold the item to the person for 10,000. But what is the possibility that you are going to be receiving this amount? What is the possibility that you are going to be receiving this amount? You have sold to the person and the person has run away. You cannot do anything. Or the person is now dead. You cannot do anything. So it means that you cannot recognize revenue because you are not going to be getting any amount from it. So what will happen is that no revenue should be recognized if you cannot receive any amount from the item that you are selling. So you just treat it as a bad debt, which will not even appear in the books. Or you can go and add that amount to revenue and come and subtract it again. At the end of the day, you are not recognizing any revenue. So if it is probable that future economic benefits associated with the transaction will flow to the entity. What again?
When the cost incurred or cost to be incurred can be measured reliably.
When the cost, when the
Cost incurred, cost to completion can be measured.
this is not construction contract. I've been forgotten to add construction contract. I will share that question with you. I have forgotten to add it. Okay. So this is not construction contract. Okay. When the cost of the transaction, when the cost of the transaction, when the cost of the transaction or the cost to carry out the transaction, when the cost of the transaction, the cost of the transaction, when the cost of the transaction can be measured reliably. Okay. Okay. What if the item that you are selling to the person has not accepted the what? The person has not accepted the item, or the person doesn't have possession of the items. What do you do? Can you recognize revenue there?
No, sir.
So how do you put that one?
When ownership and risk has been transferred to the buyer
When ownership and what?
and the risks involved.
Okay. So when ownership, risks, and rewards associated with the what? With the item has been what?
Has transferred to the buyer.
Has been transferred to the buyer or to the customer. Okay. Sometimes some of the sale can also be an arrangement for finance what? Arrangement for, or can be a finance arrangement. So what it means is that sometimes what will happen, let me write this one very well, and I will come there.
Please,
Some
ownership risk and what? I can't see.
ownership risks and rewards
Rewards.
associated with the items has been transferred to the buyer. Okay. Sometimes what will happen is that the sale can also be a financing arrangement. What does it mean? What it means is that the company or the public sector entity can actually be using the item as a collateral security to obtain what? To obtain a loan or to have a credit facility from the institution in question. What they will do is this one. Okay. Most of the times the item will be sold below what market value. If the items will be sold below market value. What it means that if you are selling to someone who is not related, if that should be a sale, you should sell at what? At the market value. You are not giving discount to the person. You should be selling at the market value, but you are now selling below the market value. And you might be having some option to purchase the item back. Those are always what seen to be a financing arrangement. So the revenue over here too, the sale should be at the market value. The sale should be at the what? At the market value or the fair value. If the sale is below the market value, what it means is that you are using the goods or the item to to actually carry out a financing arrangement or whatever. But these four are okay. So they can actually ask you theory questions on that particular one as revenue from contract with what? With customers. Okay. Let's come to 21. Let's do something on impairment. Impairment we have 21 and 26, but we are doing only
Senior,
21. Yes, please.
yeah, please. The question said state and explain. How the way we wrote it, is it okay, or we have to give further explanation to the points?
We didn't just write a point and go. You can see that we are explaining.
Oh, okay.
So I've explained the points, but I cannot write the explanation in addition to the point. No, that will be taking our time. So if you get a point, you can actually explain. But this is going to be 4 marks. So what do we explain something for 4 marks? Just write this in a sentence form and move on. Sometimes the explanation does not mean explanation. Okay. Sometimes the explanation does not mean the explanation. The explanation will mean explanation where they are asking you to state 4 items and the marks allocation is 10 marks. So it means that the explanation over there makes explanation. But if they are asking you to state and explain 4 points for 4 marks, or how? You state and still explain for 1. No, it doesn't make sense. So you just write it in a sentence format or maybe add some small short lines to it and you move on. All right. Let's come to, yeah, Senior Godwin. Let's do something on 21.
IPSAS 21, impairment of non-cash generating units. In 2019, the Nairobi County Department of Education constructed a new school, which enrolled students beginning July 2019. The furniture and other equipment cost 15 million Ghana cedis. It was estimated that the furniture and equipment will be used for 10 years. Due to COVID-19 pandemic, enrollment declined from 2,000 to 400, and parents moved their children to other special schools to observe social distancing protocols. The department decided to carry out impairment tests on the 3-story school building, and there is no expectation that enrollment would increase in the future, such that the enrollment will increase. The current replacement cost of the 1-story furniture and equipment is estimated at 9 million Ghana cedis. Required: calculate the impairment loss and explain the accounting treatment by the department on 30th June 2021 using service unit approach.
All right.
Thank you.
So I hope you can still remember the indicators of impairment, isn't it? They can actually ask you theory question on those ones. So we can remember the internal ones. Okay. And you can also remember the external ones. The external ones are just like what? Are just like the one under the 36. Both of them are just like 36. Okay. So when the asset cessation or the asset is near cessation of the demand that the asset is being used for. So maybe we are using the asset for a particular service and the demand for that particular service is now what? Is now near cessation. What it means that the demand is going to be falling or there's no other demand again. So it means that the asset will be there, the asset will be deemed surplus to requirements. So the benefit that we are going to be getting, the asset will not be given at that particular benefit at its what current stage. So what would be the issue over that one? The change can also be as a result of government policy. So the government has now come with a policy that is going to be limiting the capacity of the assets. So the asset was purchased for 10,000. Now the government is now 10,000, which will be used to produce what? 5,000 units every year. The government is now saying that the asset should be producing only 3,000. All things being equal, the 10,000 that you are saying will give you 5,000 cannot be the same 10,000 that will be giving you 3,000 every year. So you have to now calculate the new benefit that the asset will be giving to you. That new benefit is what we call the recoverable service. Then you compare with the amount that you are having. So that is the issue about the impairment. We have explained that and we have taken our time to do that. Okay, we are coming to solve question. Okay, so what is the cost of this particular furniture? What is the cost of the furniture and then the other equipment? What is the cost? What is the total cost for them?
15 million.
15 million.
Okay, and this This one, when was the school enrolled student beginning what? July. So it means that everything starts in July, isn't it?
Yes, sir.
Yes.
When are they asking us to carry out the impairment test now?
June 2020.
So how many years? How many years from the
2 years.
that will be
2
2
years.
2
years.
years.
So we need this one, we need the carrying value of what we are looking for. So we have the IPSA 21 impairment of non-cash generating units. What do we call non-cash generating units? Non-cash generating units are those assets that are not held for commercial returns. What do you mean by not for commercial returns? Those assets like the government schools. Government schools, they are not for commercial returns. The students are not paying school fees. If you go to hospital, some of the areas, some of the facilities, people will just be there. They will just admit people there without taking any money from them. That's what we call non-cash generating units or non-cash generating assets. But those assets that are going to be held for commercial returns, we call them what? We call them cash generating what? Units or cash generating assets. So the government will now be, so we can call the ECG, facilities of the ECG to be cash generating because we are paying electricity bill. The situation where the thing is being subsidized, okay, it will still be classified as what? As non-cash generating unit because in actual term, that is not the money that particular unit have to what? Have to recognize. Okay, so the non-cash generating unit is what we call, so the value you use most of the time cannot be determined because the asset is not giving us any cash flow, but we use other approaches to determine the value in use. Okay, you will still get your net realizable value. How much are you going to be selling this particular asset in each present condition? How much can you get it? Okay, but this one we are using this particular one. So we look at the carrying amount. So the carrying amount over here will be determined as the cost minus what? Accumulated consumption, isn't it?
Yes.
Okay. So our carrying amount over here, will be equal to the cost of 15 million, isn't it? Okay. Minus 15 over 10 multiplied by 2. Do you agree that that will be the carrying value?
Yes, sir.
Yeah.
Okay. So our carrying amount now,
12 million.
our carrying amount will now be 15 minus what?
All right.
Okay, 15 minus 3. That will now give us what?
12.
Okay. You can see that I've modified this question, isn't it?
Yes, sir.
Okay. So the treatment will now be different. Okay. So let's come to this one. Okay. Let's now come to this one. So they are saying that because what is the full enrollment? What is the full enrollment?
2,000.
2,000.
Okay. So we have useful life of the asset to be 8 years now, isn't it?
Yes.
So
Yes, sir.
the enrollment over the 8 years will be giving us how many students? What will be the total enrollment? What is the service benefit of the asset? So let's look at the service benefit of the assets now. Okay, the original service benefit of the assets. Would that be 2,000 multiplied by 8?
Yes, sir.
And that will give us what?
16,000.
16,000. But what are they saying right now? They say
That's
that,
reduced to 400.
okay,
That's
based on the
good.
current Based on the current situation now, the assets can only contain 400 students, isn't it?
Yes, sir.
Yes.
Okay, so what would be the benefit that the asset will be giving to us now in terms of the students? How many students are we going to be? Are we going to be what? Are we going to be having now over the remaining 8 years? How many students
3,000.
are we going to be having now over the 8 years?
3,200.
So that will give us 400 multiplied by 8. That will give us 3,200 students, isn't it?
Yes.
Okay, we are using service unit approach, isn't it?
Yes, sir.
Okay, so the service unit approach, what we do is that we pick the assets now. Okay, the question will always give you the replacement cost. The replacement cost is if you want to bring the asset to what? To its original stage. That is, if you want the asset to be giving you 2,000 students every year, that is a replacement cost over here. Okay, so that would be, so the story building is 3. So they are saying that if you want the asset should now be giving you the 2,000 again, it means that you have to replace the asset at 9,000. But in the current situation now, the asset can give us only 400, only what? Only 400 students every year. What it means is that, okay, what will be the replacement cost? What will be the corresponding replacement cost? Assuming the assets can give us what? The 400 students every year. So what we do is that we calculate the value in use of the asset by adjusting the what? The replacement cost to what? To the current situation of the asset. The 9,000 per the story building over here is based on 2,000 if you want to get the original benefits, which is the 2,000 every year over the remaining useful life. But the asset with the current situation, the asset can give us 400. So what is the portion of replacement cost that will be equal to the 400? So they are having 3-story building. Okay, they are having 3-story building. So we look at the total replacement cost for them. So we look at the total replacement cost for them. So the replacement cost is what? For the total is 9 million multiplied by 3. That will give us 27 million, isn't it?
Yes, sir.
Okay.
Yes, sir.
So let's calculate our value in use now. Okay, the value in use now is, okay, 27 million is actually based on the benefit of 16,000. But the asset can give us what? A benefit of 3,200 right now. So what would be the cost based on the current situation of the assets? That can give us 3,200. So we calculate our value in use by now using 3,200 over the total of 16,000 multiplied by the 27 million. What are we having?
$5.4.
5.4.
Okay, 5.4. Okay, this 5.4, you can also calculate it like this. Value in use, you just do your 400 divided by 2,000 multiplied by the 27 million. They are all going to be multiplied by 8, multiplied by 8. So if you divide, 8 will cancel 8. So you'll be having 5.4. Okay. So the value in use of the asset, we don't have net valuable value. So the value in use of the asset is what? 5.4. And the carrying value is what?
9. 12.
12. So what is happening there?
There's impairment.
The impairment loss of what? 12 million minus what? 5.4 million. What are we having?
6.6.
Okay. So we have our impairment loss of 6.6 what? Million. And this one should be taken to deficit. You just treat it as what? Other what? Other expenditure. And you reduce the value of the asset to be 5.4 now. So the new value of the asset. So let me just show extract over here. So statement of financial performance. You have your other expenditure, which impairment to be part of it, to be 6.6 million. And if you count your statement of financial position, the value of the assets now, so maybe you'll be having your PP or whatever the name of the asset, that will now be reduced to the 5.4 now as a new value. So you reduce the value of the asset by 6.6, and you now make it what? The recoverable amount now. So it means that the asset the value of the asset that should be giving you the 400 every year should be 5.4, not the 12 million. So go and reduce it. You are carrying the asset at a value higher than what that particular one. So that's how we go about the impairment, especially the impairment of non-cash generating units. The value in use, we use 3 methods. We use a service unit approach and what? Just give me the rest.
Recoverable service amount.
Is it recoverable or
Replacement.
Because when did I say recoverable service amount?
So are you asking for the value in use methods?
Yes, please. If you
Okay,
want
then
to, okay,
then we have the depreciated replacement cost method,
okay.
and then we have the service units we just did, and then then restoration cost restoration cost approach.
Do you know how we determine all of them?
I know for the depreciated recoverable replacement cost, but the restoration cost confuses me.
Oh, really?
Yes,
Okay.
sir.
The restoration cost, what it means is that the cost that you have to incur. Okay, let me use figures to explain that one now. Okay, so let's assume that the asset you have a car, and the car has now involved in accidents. Okay, but the carrying value of the car that you have is, let's say, 20 million. Okay, but they are giving you that the restoration cost. The restoration cost means that the value that you have to incur, okay, to now bring the asset to its original state. The asset is now damaged, so it's not in the original state. But there is the cost that you have to incur now to bring it to the original state and it will be working like the way it was working when it was new. It is 5 million. Okay, and they are giving you a replacement cost of, let's say, 24 million. So let's say replacement cost is 24 million. So replacement cost is 24 million. Okay, the replacement cost is 24 million. The replacement cost is they are talking about new assets. At the current situation of the asset now, how much will it cost you to replace it so that you can use it for the remaining useful life? That's the replacement cost, new asset. But you can see that the asset is not in a new condition, isn't it?
Yes, sir.
Okay, we have to incur a cost of 5 million to make it now to the new condition, isn't it?
Yes, sir.
Okay, so if the cost that we have to incur to bring the asset to the new state, it means that if we take that particular 5 million from this particular replacement, the new asset also, we are bringing the asset to the stage that it is not going to be new again. Okay.
Yes, sir.
So you just subtract the restoration cost from the replacement cost. So it means that we have to incur this cost to make it now new, like this one. So if you want to know the replacement cost of the asset in its current condition, which is without the restoration, it means that you just have to take the 5 from this particular price. Then you just get something like the net realizable value, which you'll be calling if you are doing inventory. So this is the new value of the inventory. This is completed inventory. We have to incur a cost of 5 million to complete the one that we have now. We want to know the value of the asset in its current condition. Assuming we are not doing we are not doing the restoration. We just take the restoration cost for the replacement cost. That will now give us 19. It means that this 19 is just like the asset in this particular condition without the work. Because if we carry out the work on this particular asset with 19, we now be having the 24 as the new asset. So we just take the 5 from the replacement cost and now get this value of the asset in the current condition that we are carrying out impairment test on it. So we have the 19 against 20. So it means that the recoverable service is lower than the carrying value. So the asset has been impaired by 1 million. I hope you are fine with that one now. Okay.
Very fine, sir. Thank you.
Okay. Okay. The Snagodin, you cannot help us to move.
All right. IPSAS 23. Revenue from non-exchange transactions. During 2018 financial year, the government of Ghana entered into the following transactions. A. The government of Ghana received 6 million cedis funding from a multilateral development agency. The agreement stipulates that the government of Ghana must repay 5 million cedis of the funding received over a period of 10 years at 5% interest when the market rate for a similar loan is 11%. B. Government of Ghana acquired an integrated solar power generating equipment with a fair value of 1 million Ghana cedis for 600,000 from the Norway government. C. Domestic debt holders have forgiven 30,000 Ghana cedis of Ghana's debts in response to the country's severe economic conditions. Let's calm down. Required. Explain how the above transactions will be treated in the financial statements of Government of Ghana in accordance with IPSAS 23, revenue from non-exchange transactions, taxes, and transfers.
Okay. So if you come to revenue from non-exchange transactions, those are these transactions that we are going to be benefiting from, and we are not going to be giving anything in return, isn't it? Okay. If you look at the first one you can see that just like concessionary was loan, isn't it? If you look at the first one, the A is just like a concessionary loan. The loan will be given to you at a subsidized rate, whilst the similar market rate will be different. So what we do over there is that we establish the fact that we are going to be accounting for this one like what? A convertible instrument in line with what? IPSA 29, which is the financial instrument. So we find a component that is for the loan and a component that is a grant. There will always be a grant component over here. So let's come here. The government of Ghana received 6 million funding from a multilateral development agency. The agreement stipulates that the government of Ghana must repay 5 million of the funding received over a period of 10 years at 5% interest, when the market interest rate for similar loan is what? Is 11%. Let's come here. How much should be what? How much should be paid? How much should be paid in actual sense? How much should be paid? How much?
6 million.
It should be 6 million, isn't it?
Yes, sir.
But they are asking us to pay what?
To pay 5.
What is happening with the 1 million?
Grant.
Okay, the 1 million is just treated as a grant, isn't it?
Yes, sir.
Okay, so revenue from non-exchange transactions. Revenue from non-exchange transactions, you can only recognize the revenue or an asset when it is probable that future economic benefits associated with that particular item will flow to what? To the public sector entity, or the public sector entity can actually exercise control over that particular item if you count to an asset. If you count to an asset. So we are going to be having a loan. We have received a cash of 6 million, but the amount that we are going to be showing as a loan in our books will be 5 million, and the remaining 1 million will be treated as what? As revenue, isn't it? Because they are giving us that particular amount for free. So the government of Ghana will recognize a loan of 5 million, which will be a liability. Will recognize a cash of 6 million and recognize what? Grant or donation of what? Of 1 million. So the 6 million will be the amount received. Cash will be increasing for them. The 5 million will be treated as a liability because they have to pay this amount back over 10 years, paying interest of what? Interest of what? 5%. So whenever the interest is being paid, they will recognize the interest as interest expense. But the remaining 1 million of this amount, they are not going to be paying it. It means that this amount is given to them for free. They have actually received this particular amount already. So 1 million of this amount will be treated as what? As grant revenue. That is it. 1 million of this amount will be treated as what? As grant what? Revenue. Okay, let's come to the government of Ghana acquired an integrated solar power generating equipment with a fair value of what? 1 million for 600,000 from the what? From the Norway what? Government. What is happening over here? They are giving them asset worth 1 million, but they are paying what?
600,000.
So what is going to happen?
So we can see that a portion of it is given to us like a grant.
Or a donation?
Yes, sir.
Okay,
Yes,
so
sir.
how do you go about it?
So we'll just credit our cash book with 600, the grant or donations account with a balance of 400, and then debit our equipment with the full 1 million.
Okay.
Yep.
Okay. So what will happen is that the government of Ghana is going to recognize the asset at what? At fair value, isn't it?
Yes, sir.
Which is 1 million. Then they will pay what? 600,000, and the remaining amount over there will be treated as what? As donation or grant or gift. Okay. They are giving us, we should be paying 1 million for the assets, but they are asking us to pay what? 600,000. It means that they are saying that okay, they are going to be they're not going to be asking us to pay the 400,000. So the 400,000 is now what? It's now something like a gift to us. So they will be recognizing this one. Why? Because they have actually received the assets. They have received the asset already. And there's no condition attached to what? The 400,000. So no need to recognize a liability in relation to that particular item. No. So we have received the assets. We have paid the 600,000. So the 400,000, we have the benefit. We are going to be enjoying the benefit over there. Therefore, we have to recognize what? A revenue, which will be from an exchange transaction of what? 400,000. So the government will be recognizing the asset in their books at 1 million, having a cash of what? 600,000 being going out, and what? 400,000 being revenue as what? As donation or grant or gift. It will be under that particular what? Classification. It will be under that particular classification. Domestic debts, loan forgiveness. Domestic debts, holders has forgiven 30,000 of Ghanaia's debt in response to the country's what? Severe what? Economic conditions. What is going to happen here?
Okay, so with debt forgiveness, we can recognize in terms of revenue that is a grant of 30,000, and then also reduce our domestic debt by the same amount.
Okay, so the debt forgiveness, what is going to happen is that the debt forgiveness is going to be reducing our what? Our liability, isn't it?
Yes.
Okay, and this amount we are not going to be paying again. Okay, since we are not going to be paying again, it means that our liability is going to be reducing. What will be the other item that will be what? That will be reducing or increasing? We are going to be crediting our liability. We are going to be debiting our liability, and the corresponding entry will be for donation or grant or whatever. So this particular amount is a reduction to liability. And since it has been confirmed that we are not going to be settling that particular obligation again, then it means that that particular amount must be treated as a gain for us. So our liability is reducing. So the government of Ghana will recognize 30,000 as a gain or 30,000 as a donation from the what? From the debt holders, and reduce their what? Their domestic debt also by what? By the 30,000. Okay, so that's what they are going to be doing about that particular issue there. Okay, so a very simple one there. Let's do something on IPSAF 31, intangible assets. First one.
IPSAS 31, intangible assets. Question 1. On 1st April 2017, Airtel acquired a license for operating a TV channel for 86.3 million, out of which 50 million was paid immediately. The balance amount is payable on 1st April 2019. A mega social media and print media campaign was launched to promote the channel at a cost of 10 million Ghana cedis. The transmission of the channel started on 1st August 2017. The license is valid for 5 years. In the absence of any active markets, the management has estimated that residual value of the license would be 50 million Ghana cedis and 20 million Ghana cedis at the end of 5 years and 8 years respectively. Applicable discount rate is 10% per annum. Required. Discuss how these transactions should be recorded in ZL's books of accounts for the year ended 31st December 2017.
Okay, so this is about intangible. Okay, I just remove some things from it so that it should best fit into the public sector question. Okay, so we are buying the license for what?
86.3.
Okay, but are we paying the full amount? Are we paying the amount? Are we paying the amount now?
No, we paid 50.
We are paying 50 million now. Okay, and the remaining
Yes.
36.3 will be paid in what?
2 years
In
time.
2 years' time.
Okay. If you should have the cash today, are you going to be paying the 36.3 today that you are going to be paying in 2 years' time?
No.
No.
Okay. So it means that since you are going to be holding someone's money for some time, the person has added time value of money, isn't it? Okay.
Yes.
So what you do over here is that at the transaction date, okay, so we come to the IPSAS 31, which is intangible assets. So we come to question number 1. So you find the cost of the what? The license. So the cost of the license on at April. So the cost of the license at April 2017. Okay. What will happen over here is that we are paying. So the amount that we are paying now is what? 50 million, isn't it?
Yeah.
Okay. That is a cash price. But the remaining 36.3 will be paid in what? In 2 years' time.
In 2 years.
What it means is that since you are going to be holding my money for 2 years, I cannot tell you that, okay, you are owing me 30 million now, so you have to pay me that 30 million in 2 years' time again. If you should give me that 30 million, what I will do with the 30 million will be what? Will be enough, or I can use the 30 million to buy other items that will be giving you profit. But since you want to now hold on to that particular amount, what it means is that you are going to be paying me the profit or the interest that I'll be losing. So what will happen is that you have to now find the cash portion of that amount and then the interest amount. So that particular 36.3 is actually having a financing component and then the amount of the license. So we find the present value of that amount. The present value is the amount that you should have paid today for the license if you should have cash. But since you are not paying, the person has now added the interest that the person will be losing for the 2 years if you are holding on to the money. So that particular 36.3 million is having a component of the amount for the license and also the interest that the person is charging you. So we find the present value. How do we find the present value? It is the future value divided by the compounding factor, and that will give us the 1 plus 0.1 exponent 2. So the discount factor or the borrowing rate for the person is what? Is 10%, or you can say this is the same as, so 1 over 1 plus r exponent and multiply by the future value. We are looking for present value. I'm sure most of us, we are familiar with the issues of the present value and the future value. What are you getting?
It's 30 million. The value is 36.3, so you get it.
Okay, this is 36.3. So 30 million, isn't it?
Yeah.
So the cash price of the license, the amount that you should have paid today is 30 million in addition to the 50. So the cost of the license itself is what? Is 36 million. So what you do is that the cost of the license is 80 million rather. Then you will now do liability. You are owing the person. So you are going to be owing the person a liability of what? So you'll be, as of today, you are owing the person also what? 30 million. Okay, so the amount that you have to pay the person today is 30 million. So you are owing 30 million, which the person will be charging interest on it at the end of every year. And at the end of the 2 years, you pay the person the 36.3 million. So this is what we do over here. Okay. Okay, the balance is payable on July 2019. We have done that. A mega social media and printing campaign was launched to promote the channel at a cost of 10 million. The transmission of the channel started on 1st August 2017. The license is valued for 5 years. Okay. The advertising and other issues, are they necessary? Are they things that we have to do to prepare the license for use? Are they things necessary to make the license ready for use?
No.
Okay, so that we can start using the license without even doing the advertisement, isn't it?
Yes, sir.
So we only capitalize costs that are part of the activities to make the asset ready for use. We have purchased the license. We can start using the license now without doing advert. So the advert is not going to be adding anything to the license. It's not something that will make the license ready for use. No, we can use the license now. We have acquired a license. We can put it into use immediately.
Sir.
Yes, please.
Sir, please, the amount for the TV channel, I think is 86 million instead of 36 million.
The amount for TV was?
The 36 is 86.
The amount for the TV channel is what?
86 million instead of 36 million.
Okay, where are you reading for? Where are you reading from?
Sir, from the screen.
Okay, read to the end. Read to where the full stop is.
Okay, sir, I've seen it. Thank you.
Okay. Okay, so the mega and this particular campaign to promote advertising of this one is going to be treated as what? So advertising cost over there is going to be treated as an expense. So this will be expensed. So advertising of 10 million will be expensed because it's not a necessary cost to make the license ready for use. But if we should change the license to our name, it means that if we don't change the license to our name, there's no way we can use it. If we don't change the license to our name, there's no way we can use it. For that particular one, then we can add that particular cost to the initial cost of the asset, because if we don't change the name of the license, there's no way we can actually use the license. So the changing of the name, the cost to change, will be seen as a necessary activity to make the license ready for use. But advertising, we can use the license without advertising. So advertising cost will be expensed. All right, let's come to this particular situation. They say that the transmission of the channel started on 1st August 2017. The license is valid for what? For 5 years. The license will be operational from the day that you have acquired the license. The license is operational from the day that you have acquired it. The license is for 5 years. The time that the license has been granted to you, the people responsible for giving you the license will start counting from that day. That is what Ghanaians landlord, they do. So if you come for the room on 1st January, but you are moving in July, they will start counting from what? From January, because the room was available for use from that date. You decided to come in July. So the license becomes operational at the time that you obtain a license, unless there are certain things that you have to do to the license before it will become operational. But the question is not giving us information on those things. So the people will start from what? The time that you have obtained a license. They will start what? They will start counting the life of the license from that time. If you have gone to Registrar General to obtain business certificate, the business certificate, the time that they have given it to you, it becomes operational from the time that they have printed it out and it has been given to you. Whether you decide to start a business or not, at the end of every year, you have to renew it. So the license is operational from the time that you have obtained a license. So you start using the license from 1st April. So amortization of the license will start from what? 1st April, not the time that you started to to transmit the TV channel. That is the time that you want to come live, but the license will start operating from the time that you obtain it. So amortization of the license starts from 1st April, not 1st August. So at the end of this year, we are going to be using the license for what? For 9 months. We have to amortize it for 9 months. The license is for 5 years. We have used 9 months out of it because the question is asking us for 31 December 2017. April to December, we have used what? 9 months out of this license. So we calculate amortization of that particular license. So we look at amortization of the license. That will be 80 million divided by 5 multiplied by 9/12. What are we having?
$12.
We're having 12.
Yes, sir.
Okay, so we have 12 million. Okay, so we are going to be paying the people a certain amount of money. Okay, we are owing the people now a certain amount of money, which carries interest at what? At 10%. So at the end of this year also, we have to know our finance cost on this particular amount. Okay, you are owing somebody 30 million. The person is charging interest of what? 10% every year. So you have done 9 months. It means that the person has to charge you interest for 9 months. So we come over here, our finance cost will be the discount rate multiplied by 30 million, which is the amount that we are owing, multiplied by 9 over what? Over 12. What are we having?
$2.25.
2.25.
25.
So we have 2.25 million. Okay. So what we have to do is that if you go to the statement of financial performance,
2.25.
okay, you'll be having consumption of what? Consumption of fixed capital or amortization. So you have the amortization expense to be 12 million, isn't it?
Yes, sir.
So interest expense will be what?
2.25.
Okay. And the advertising cost will be under use of goods and services, where we don't have these things over here. That will be under what? That will be
10 million.
okay. If you come to your statement of financial position, under your assets, you'll be having license, isn't it?
Yes, sir.
At 80 minus 12, isn't it?
Yes, sir.
And that will be
68.
okay. Then you go to your liabilities, non-current liabilities. So you come to your non-current liabilities here. Non-current liabilities over here. Then you can have something like deferred payments. And the deferred payment was 30 million at the beginning. And you have to pay interest of 2.25 now. And that will give us 32.25. Okay. So these are the entries that these people are going to do what? Are going to place for the active market. Okay. The residual value for intangible assets. We don't use what? We don't determine residual value when there is no what? Active market. So residual value is determined in relation to active market. It means that there's a market ready to purchase this particular license at a particular what? At a particular rate. So they say that in absence of any active market, management has estimated that residual, no, we don't use the residual value when there is no active market. This is intangible assets. if it should be a tangible asset, even if you have an accident car, someone can actually buy it. But if you come to license, now the license is worthless. Nobody will be willing to buy it. So the residual value of intangible assets are measured in reference to active market. If there's no active market, if a residual value is given to you, ignore. What do we mean by active market? There is a committed person to purchase this particular intangible asset at the end of each useful life. And there's no active market, so we don't consider the residual value when we are calculating the amortization. It's going to be what? 0. Unless they are saying that in the management has estimated that in active market, this will be 15 million, 20 million, something. But this one, in the absence of, there's no committed party willing to purchase this particular asset at the end of what? At the end of its what? Useful life. So we don't use what? Residual value for intangible asset, like how we use it for the tangible asset. Please, let's do number 2. Let's do number 2 and see what we can do about that one.
All right. Question 2. AB Ministry prepares its financial statements applying international public sector accounting standards on accrual basis. The following transactions relate to AB Ministry. A. The ministry developed a system for effective handling of public services offered by ministries to citizens. During the financial year ending 31 March 2021, expenditure incurred for the development of the system was 10 million Ghana cedis, of which 9 million Ghana cedis was incurred before 1st March 2021, and the remaining was incurred between 1st March 2021 and 31st March 2021. The ministry is able to demonstrate that as March 1, 2021, the newly developed system met the criteria for recognition as an intangible asset. The recoverable service amount of the system, including future cash outflows to complete the development before it is available for use at 31 March 2021, is estimated to be 5 million Ghana cedis. During the financial year ending 31 March 2022, expenditure incurred is 20 million Ghana cedis. At the end of this financial year, the recoverable service amount of the system, including future cash flows to complete the system before it is available for use, is estimated to be 90 million Ghana cedis. Required: prepare the financial statements extracts for AB Ministry to show how AB Ministry will report the above intangible assets and related expenditure for the years ended 31 March 2021 and 31 March 2022. Show up separate workings where applicable.
Okay, so this one is about development expenditure, isn't it? This is
Yes,
about
sir.
development of an asset. So when do we start capitalizing the development cost?
When the entity is certain that future economic benefits can flow into the entity as a result of this assets we are developing.
Okay, so let's take the question now. They say that during the financial year end 31 March 2021, an expenditure incurred for the development of the system was 10 million, of which 9 million was incurred before what?
It was incurred before 1st March.
Okay, 9 million was incurred before 1st March. The ministry is able to demonstrate at 31 March 2021, the newly developed system made the criteria for recognition as an intangible asset. So out of the 10 million, how much will be recognized as, or how much will be capitalized as an intangible asset?
1 million.
It will be 1 million, isn't it?
Yes.
So the remaining will be
Research.
okay. So we come to question number 2B here. So the development expenditure capitalized as what? As an asset will be what? Will be 1 million. That will be 1,000, isn't it?
Yes, sir.
Okay. So it means that the recognition criteria will be what? Has been met from 1st March. So all the expenditure that has been incurred before the 1st March will be treated as a research expenditure. The expenditure that will be incurred even if we are not certain that this particular process is going to be successful. So those 9 million which has been incurred before the development expenditure met the recognition criteria as an intangible asset will be expensed now. So 9 million, okay, 9 million which was incurred, 9 million which was incurred before, 9 million which was incurred before 31 March 2021 will be expensed as a research cost, and willing the expenditure incurred after okay, this not be 31st, it should be 1st March. So only the expenditure incurred after 1st March 2021 will be recognized as what? As intangible assets. Okay. Will be recognized as an intangible asset. They are giving you something like that, please. For intangible assets, what we do is we actually carry out impairment tests on the asset. What do we carry? What do we do? What do we call the impairment test? Okay. We are saying that the cost, the benefit that this can give us is 10,000. But the actual benefit that we can get from it is this amount. So it means that we are carrying the asset at a value higher than what it should have been the actual value. Okay, so we carry out impairment tests on these particular ones also. So let's come to the end of the year. The new development system meet the recognition criteria for intangible assets, the recoverable service amount of the system, including cash flows to complete the development before it is available for use at 31 March. At 31 March is estimated to be what? 5 million. Is there any impairment, any issue of impairment on this particular item? We are having 1 million as the cost, but they are saying that the recoverable amount is what? Is 5 million. Is there any impairment over here?
No, sir.
Okay. So you come over here and you have recoverable amounts at the end of the year, March 21 was 5 million. Okay. No impairment loss should be what? No impairment loss should be recognized. Since the recoverable amount is higher than the carrying value. Higher than the carrying value. Okay. But let's come to the extracts. So financial estimate, financial statement extract. We have the statement of financial performance for them at the end of this year. So statement of financial performance. So we'll be having the research expenditure. So if we have the use of goods and services, that will be for administrative purposes. So we have, that will be 9 million, isn't it? So we have statement of financial position. Statement of financial position. We have assets as development expenditure or development cost to be what? To be 1 million, isn't it?
Yes, sir.
Okay. Let's go to March. Let's go to March 2022 now. March 2022, the development cost from the what? From the first period will be brought forward here, isn't it?
Yes, sir.
Okay. So development cost of this will be brought forward over here. So that will be 1,000. Okay. Were there any development costs, any further development costs incurred for this year?
Yes, sir.
How much is that?
He said till date it end to 20 million.
Okay, during the financial year ending 31 March, expenditure incurred is what?
It's 20 million.
Okay, so it means that we have incurred additional cost of 20 million. That will also be capitalized because the recognition criteria was met some time ago. So we count to additional expenditure. That will be 20 million. So the total will give us 21,000, isn't it?
Yes, sir.
Okay, let's go there. What is the recoverable amount?
Same recoverable is estimated to be 19 million.
Okay, is there any issue of impairment there?
Yes, sir.
Okay, impairment of how much?
Of 1 million.
Is it 1 or 2?
Oh, sorry, 2 million. Sorry.
Okay, so we have recoverable amounts of 19 million, which is 19,000. So there will be an impairment over there. We are carrying the assets. We are the benefit that our cost relating to the benefit that we are having is different from what the assets will actually be given to us. So we have 21,000 minus 19,000. So we'll be having impairment of 2,000, which is 2 million. Okay. So you count your statement of financial performance. Statement of financial performance. You have impairment loss of 2,000. And your statement of financial position, what will be the value of the asset there?
19,000.
Okay. So that will be the recoverable amount now. So statement of financial position, you are going to be having assets, and that will give you development expenditure or cost of 19,000. Okay. So that is all that there is about development expenditure, recognition of research and development expenditure. We only recognize development expenditure when management is for the day that the management is convinced that the item that we are developing will be what? Will be feasible or will be successful. We only recognize the development or we start capitalizing the development expenditure from the date that management is convinced that what? This particular item is going to result in what? In a positive cash flow. And that is the situation that is happening over here. Okay. So there is no big deal there. Okay, there is no big deal there. All right, so the B there, you can actually try that one. Let's look at the concession asset. You have to look at the theory issues. Well, the conditions for recognizing assets and those ones. Like this one, let's just do the what? The A.
Okay. A. The government entered into an agreement with Japo Limited to build and equip the State's General Hospital through PPP arrangement at a cost of 2 billion Ghana cedis in year 2016. The project was completed and commissioned during the year. The contractor is to operate the hospital for a period of 20 years and thereafter hand over to the government. The contractor is to recover fully his investment through medical fees from patients. From available information, A total of 250 million Ghana cedis was realized by the contractor from patients in 2017. So I'm done with the A.
Read all. Let's take all of that ones.
Okay, so B, the government also entered into a service concession arrangement with a Chinese construction company to construct a 15-kilometer ring road on behalf of the government in 2015. The road was constructed and commissioned in year 2016. The terms of the arrangement were as follows. Cost of the road project is 980 million Ghana cedis. The Chinese company to collect toll fees for a period of 10 years, estimated at 650 million Ghana cedis. The government to pay the contractor the sum of 450 million Ghana cedis within 10 years on equal annual installments, and the difference between the cost of the project and total revenue accruable to the contractor to be treated as return on investment. At the end of year 2017, the contract was able to collect a total sum of 100 million Ghana cedis as toll fees. The government was also able to fulfill its own part of the arrangement, so required, explain with relevant calculations how the above transactions should be accounted for. Show extracts in the financial statement at 31st December 2017.
Okay. So this is about concession arrangements. Okay. So they are saying the government of Ghana entered into the following contract in order to meet one of the party promises to the state citizens. The government entered into an agreement with the Japo Limited to build and equip the State General Hospital through PPP arrangement at a cost of 2 billion in 2016. The project was completed and commissioned during the year. The contractor is to operate the hospital. Okay, the contractor is to. Okay, the project was completed and commissioned during the year. The contractor is to operate the hospital for 20 years, and thereafter hand over to the government. The contractor is to recover fully his investment through the medical fees from patients, from available information. A total of 250 million was realized by the contractor from patients in 2017. Was realized from the contractor in 2017. Okay, let's take the first one. Okay, what is the cost of the facility?
$2 billion Ghana cedis. Sorry.
2 billion Ghana cedis, isn't it?
Yes, sir.
Okay. After the 20 years, what will happen?
It will be handed over to government.
If it is handed over to government, the government will be treating that as an asset at the same time.
A liability.
No, if it is handed over to the government after the 20 years, if it is handed over to the government after the 20 years,
it's treated as an investment asset.
no. Yes, let's get this one right now. If I've built something for 10 million. Okay, I've built something for 10 million. I'm saying that I'll use it for 10 years and I'll give it to you now. Okay, so I will do this and I'll give it to you at what? At 10 million at the end of the 10 years. How are you going to be treating this? You have the asset at the same time. What are you going to be doing over there? You have the asset.
At the end of the 10 years.
Yes, I'll give you the asset that is worth what? 10 million. So you'll be having the asset. What will be the corresponding entry? You are going to be debiting your asset. What will be the other thing that you are going to be what? You are going to be
You
crediting.
credit your liability.
No, he's not going to be paying. Okay.
What of donation?
It will be treated as a donation, isn't it?
Yes, sir.
Okay, I'm giving the thing to you for free. Okay. But to be at a safer side, you can also treat this particular item as an asset now, because I'm assuring you that at the end of the 10 years, I'm giving the asset to you. So what will happen is that you are going to be having the asset of 10 million now, okay? And you know that this asset will be given to you over 10 years. So the donation is supposed to be debiting an asset and also recognizing revenue. But this revenue, the asset will become yours over 10 years. So you can also classify the what? The 10 million, which is the donation that you'll be recognizing as a revenue as what? As a deferred income or something. So at the end of every year, you recognize that part to what? To revenue. You recognize that part to what? To revenue. You recognize that part to revenue. So at the end of every year, you are going to be taking that part to revenue. So this one, the government is going to be controlling the asset through the residual value. You see, the government can recognize a concession asset when the government control the asset through ownership, or the government can actually direct how the asset should be used, or the government control the asset through what? Residual value, or the beneficiary what? Benefits. The government is going to be having this asset at the end of the concession period. So the government control the asset through the what? Residual value. So at the date of this arrangement, the government is going to recognize what? A concession asset. This 2 billion for the government over here. If the asset should be given to the government currently and the person is not going to operate it, it means that someone has built the asset and give it to the government for free. So the government will be recognizing what? Asset at 2 billion and also revenue at 2 billion. But since the asset will be transferred to you over 20 years, you also have to spread the revenue over what? Over 20 years. That's how we go about it. So at the start of this particular arrangement, the government is going to be recognizing an asset at the same time as what? Concession liability. The concession liability is just a what? It's just a grant that the government will be recognizing in bits. So at the date of this arrangement, the government has to recognize a concession asset because the government will control the asset, or the government is going to have control or ownership over the asset through the residual value. So what we do is we come to this place, we have the IPSA is sub 32, which is a concession. Which is a concession? So the government will recognize concession assets. So the government will have concession assets in 8 books at, okay. So that will be we are keeping, so let's have it in million. So if you are having it in million now, it means that will be 2,000, isn't it?
Yes, sir. Yes.
Okay. So that will be 2,000. So the government will also be having a corresponding item as what? Concession what?
Liability.
Okay. Concession liability at the same amount, isn't it?
Yes,
so we
sir.
have the 2,000. Okay, by the end of at the end of what? At the end of 2017, what is happening? The contractor has recognized what? 250 from what? From the using of the asset, isn't it?
Yes, sir.
So what is happening? It means that the liability will be reducing by 250 million, isn't it?
Yes, sir.
Okay, so this is what you do over here. You debit your concession assets. Okay, concession liability rather. So you debit your concession liability with 250 because the person has recognized what? Has realized 250. So the person will be left with 1750. This particular one now, the government will also recognize that portion of the revenue, because the government is supposed to be recognizing the 2,000 over 20 years. But since the person has now recognized that 250, it means that the liability has reduced. So the government will also be recognizing that particular portion as what? As the donation. So the government has to recognize that portion of the donation now. Okay, so we now come to credit our revenue. Credit our revenue as a 250. Okay, so at the transaction date, Government of Ghana should recognize a concession asset as well as a concession liability at an amount of 2 billion Ghana cedis. Okay. Subsequently, any amounts received by the contractor will be treated as revenue and reduction to the concession liability. Okay, just let's take the second one now. Okay.
So you said the second one, government entered into a concession agreement with Chinese company to make a 15-kilometer ring road in 2015. And it was constructed and commissioned in 2016. The terms were, one, the cost of the project was 980 million Ghana cedis. And the Chinese company will collect toll fees for 10 years, estimated at 650 million Ghana cedis. And then the government is going to pay the contractor a sum of 450 million Ghana cedis within 10 years on equal annual installments. And the difference between the cost of the project and the total revenue accruable to the contractor is to be treated as return on investment. And they are saying at the end of 2017, the contractor was able to collect a total sum of 100 million as toll fees. And the government was also able to fulfill its own part of the agreement.
Okay, so you can see that this particular asset will not be given to the government for free at the end of the 10 years, isn't it?
Yes, sir.
Okay, so what is the value of the asset?
It's 980 million.
Okay. Out of this 980 million, the government will pay how much?
450 million.
Okay, and the people will receive the remaining amounts. What will be the remaining amount that they are going to be receiving?
650.
No, the 650 over there is including what they are telling us that we should treat as return on investment.
Is it 100, sir?
No, please.
530.
That will be
530
Yeah,
series.
the arrangement is 980. The government is going to be receiving 980 as the assets, and the government is going to pay 450 over there. The remaining of the 980 will be received from what? From the
toll fees.
Okay, from the people that are going to, or from the public, or from the citizens. So let's come to the B over here. The government is going to be recognizing a concession asset at an amount of 980 million, isn't it?
Yes, sir.
So the government will be having a concession liability of what? The 980 minus what? The portion that the government will be paying, isn't it?
Yes, sir.
Yes.
That will give us 530, isn't it?
Yes, sir.
So we have the cash obligation. Please, you will always separate the concession liability from the cash that the government will be paying itself. So the government will be paying the 450. So in total, this will now be the 980. The question is saying that any difference in the amount should be treated as what? Should be treated as a return on investment to the people. That is none of our business. So we are only interested in accounting for this one. The asset will be given to the government for 980, and the government will be paying 450 out of it. It means that the people are going to be receiving the remaining what? 530 from the what? From the public. Okay. So this is what we do. So we have a concession asset. We are not giving a useful life. This asset, after 10 years, it will be given to the government. The government is going to use it for a certain number of years. So we don't have information about the what? About the useful life of the asset. So we cannot depreciate it. Okay. But if you come to the concession liability over here, what is going to happen? At the end of the year, okay, at the end of the year, which is 2017, what happened? The government has paid its portion of what? Okay. So the government has made payment of what? So what will be the payment that the government will be making? 450
45.
divided by 10, isn't it?
Yes, sir.
So that will give us 45. Okay. The people has also received proceeds of what?
Of 100 million.
Of 100 million. Okay. So this is what will happen. This is what will happen. So we now come here. If you come to your concession asset now, the concession asset will still be the same at the end of the year. But if you come to your concession liability, you have the opening balance of what? Of 530 million, isn't it? Okay.
Yes,
And
sir.
the receipts, the people have received now what? They have received 100 million. So it means that they are left with 430 to receive, isn't it?
Yes, sir.
Okay, let's come to the cash obligation from the government side. Okay, the cash obligation from the government side, that will be the opening figure, the figure which is the opening balance. That will be 450, isn't it?
Yeah, yeah.
The government has paid what?
It's paid 45.
So this will now reduce by what? 45, but now making 104. But what will be the corresponding entry for the 100? The government is going to be treating the 530 because the government is not going to be paying anything for the 530. So the 530 will be treated as a donation for what? For 10 years. But the people will now receive what? 100 million out of that. So the reduction in the liability will be treated as portion of the what? The donation that has been realized by the government. So the 100 million over there will be treated as a revenue for the government. Okay, because this is a grant. This is a donation or the grant to the government. And the government will be recognizing this over what? Over 10 years. So whenever any amount has been received from those people, the amount that the liability will be reducing, that amount will also be recognized as what? As the portion of the donation or the grant recognized or realized by the government for that particular period. That is how we go about the concession arrangement. So the government will be recognizing a concession asset of 980, and the government will be recognizing a cash obligation liability because the government itself is going to be paying what? 450 of that amount. So the remaining will be collected through the what? Through the using of the facility. Any process, any amount that will be received from the public will be treated as a reduction to what? To the concession liability, at the same time treated as a portion of the grant recognized by the government, and that will be revenue. Any amount that the government is paying will be between cash and the liability. That is it. Let's do something on IPSAS 19. That will be provisions. Then we see what we can actually do like that. Let's do something on the 19 over here. Just take the 19 for us.
Okay, IPSAS 19, provisions. So, Terqua Assembly, TA, is in the process of finalizing its financial statements for the year ended 30th June 2019. Following matters are under consideration. A. On 10th July 2019, the owner of the adjacent building filed a case against TA claiming 50 million Ghana cedis. The claim is made in respect of severe damage to his building during a fire incident at in TA's head office in June 2019. He is of the view that TA was negligent in maintaining fire safety systems in its head office. According to TA's lawyers, there is 70% probability that TA will be found negligent and would need to pay 40% of the amount claimed. B. In May 2019,
Let's do it that
TA's
one. Let's do it that one. Should there be any provision relating to that?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, if there should be a provision, the provision should be how much?
40%
40% of
of
the 50
50
million.
million.
Okay, so you can see that this is relating to fire what?
Fire.
Fire incident, isn't it?
Yeah.
Yes, sir.
But this particular
Yes, sir.
incident is not occurring after the what? After reporting date. It occurred during the reporting date, isn't it?
Yes, sir.
So it's not what? It's not no adjusting event. It's actually incurred during the year. They say incurred in June 2019. That is during the year. This particular incident incurred during or occurred during the year. So it means that there's evidence of this particular issue occurring at the reporting date. But they failed to what? They failed to make provision for that. So this is not no adjusting event, and it is neither event after reporting date, because the thing occurred during the year. Okay, they are saying that they will be found negligent. It means that they will say that they have no excuse, and they will be paying what 40% of that amount. Okay, they will be found negligent, and they will be paying 40% of that amount. Okay, so let's come here. TA needs to make provision relating to the fire incident, since there is a greater probability of paying an amount to settle the victim or whoever. Okay, so based on the lawyers the amount of provision to be made should be based on the lawyer's estimate, isn't it? Lawyer's estimates. So we have a provision over here. There is a possibility that they are going to be paying 40% of that amount, isn't it? Okay. There's a 70% chance that they are going to be paying that amount. So it means that they are going to be paying. Okay, so you just do 0.4 multiplied by what? The 50 million. What are you having?
20.
So you have 20 million. Okay, so let's move on to the next one now.
B. Please can you hear me?
Yes, please. Yes, please. You are together.
Okay. B. In May 2019, TA's board of directors decided to relocate its regional office from Aflao to Keta. In respect of this, a detailed plan was approved by the management and a formal public announcement was made in June. TA has planned to complete the relocation by December 2019. The related costs have been estimated as under. So we have redundancy payments, cost of moving office equipment to Keta, compensation to employees agreeing to relocate, and salary of existing operation manager to bracket responsible to supervise the relocation. C. Should I take C?
No, let's do the A first. So this is about restructuring, isn't it?
Yes, sir.
And we said that you should only make provision to restructuring when there is what?
When management has actually made communications of its intention to restructure.
Okay, or they have a detailed plan or formal plan, or they are committed to what? To carrying out the restructuring, isn't it?
Yes, sir.
Okay. So looking at the question, is there any information that they have announced and they are committed to that, to the restructuring?
Yes, sir.
Yes.
They
Okay.
said a detailed plan was approved.
Okay. So the detailed plan has been approved and everything. The question will tell you whether they have met the recognition criteria for the provision. So they have met that, and we have to actually what? Make provision now. We make provision based on only what? Only the cost that the unavoidable costs associated with the provision and the what? And the costs that are not what? Associated with the ongoing activities of the business, isn't it?
Yes.
Okay, let's take them one by one now. The redundancy payments, is it a cost that will be incurred if the restructuring is not done?
No, sir.
Redundancy
No.
payment, is it a cost that will be incurred if the restructuring is not done?
No, sir.
No.
Okay, so what we do is that we make the provision now based on only those costs that will be necessitate. Those costs are coming in as a result of what? The restructuring. And the cost is not what? It's not associated with the ongoing business activities of the entity. The redundancy payment is just like what? The people that will be laid off from the restructuring, those that will be made unemployed for the restructuring, the severance payment that you are going to be paying to them, that is what we call the redundancy fee. So we come to the provisions over here. Then we now have the redundancy fee as one of them. Okay, redundancy fees or the cost. How much is it?
20 million.
Okay, so 20 million. Let's go to the next one now.
Cost of moving office equipment to Keta.
The cost of moving office equipment to Keta, is it an activity associated with the ongoing activities of the entity?
No, sir.
Are you sure?
Yeah, they are relocating, so it's fine.
Okay. Even if you are not doing restructuring, you can also move what? Idle facilities from one location to the other. So this is a cost or this is an activity associated with the ongoing activities of the entity. So no provision should be made for this particular one. We are relocating the office equipment to our new location. We still continue our business activities. So it's an activity associated with the ongoing what? Activities of the business, no provision. Let's come to this place. Compensation to employees agreeing to relocate. Is there a cost associated with the ongoing activities of the entity?
No, sir.
Compensation to employees agreeing to relocate. Is there a cost that is going to be associated with the ongoing activities of the entity?
No, sir.
Are you sure? The people the people that are relocating, where are they going to be working?
You're going to be working at Keta.
And the Keta, is he not the entity's branch or is he not going to be the entity's activity?
Yes, sir.
So if we say the ongoing activity, we are not talking about where they are closing down. Anywhere within the organization, if they are still going to be working anywhere within the organization, and that is going to be associated with organizational activities, that is what we call the ongoing activity. Ongoing doesn't mean that we are talking about the activity at the place that we are closing down. You can't have ongoing activity at where you are closing down. But wherever you are taking the person to, is it relating to the activities of the organization again? That is what we call the ongoing. So this compensation is to employees that are agreeing to relocate. They are still going to be working for the organization. So this is going to be what? This is going to be a cost associated with the ongoing activities of what? Of the organization. Salary of existing operation manager responsible to supervise the location. salary of existing operation manager responsible to supervise the relocation. Salary of the person. When do we pay salary? When we employ the person, isn't it?
Yes, sir.
So it means that this 2 million is still part of the salary that we are paying to the person, but we are just asking him to what? To supervise. So we are not incurring any incremental cost over there. Whether the person supervised that one or not, the person will still receive salary. Because the person is an existing supervisor. It's not a different person that is coming to supervise, and after supervising, the person will go. No. It's not a special person that we are bringing to supervise. It's someone that we are currently paying, and we want the person to come and supervise. So you are just coming to supervise the what? The operation. You are an employee, you say, oh, we are going to be doing something somewhere. So go and supervise that. Whether you go there or not, we still pay your salary at the end of the month. So this one is just what? It's just existing cost that we are doing. It's not a cost associated with the restructuring. Unless we are paying a bonus or additional bonus as a result of the person supervising. So if it should be, we are paying what? A bonus to the what? To the existing supervisor for the what? The restructuring. It means that bonus, we are paying that bonus purposely for the supervision. So that will be a cost coming in. If not for the restructuring, that bonus will not be paid. But this is a salary of existing operation. Salary means his original salary. You can't go and supervise just something for a day, we pay you salary. It doesn't matter. It cannot happen like that. So his existing salary, whether he supervised or not, he will still earn this particular salary. So in this case, it will be only the redundancy payment that will be treated as what? As a provision. All the rest of them are associated with the ongoing activities of the organization. So no what? No provision. So 20 million alone. 20 million alone. Just take the last one.
C says TA had 6,000 unsold units of product A as at 30th June 2019, and it was acquired at 500 Ghana cedis per unit. In June 2019, the selling price of product A has fallen to 350 cedis per unit. TA acquires product A under the contract in which TA has to buy 10,000 units of product A per month for 500 cedis per unit. The contract is valid till 31st August 2019, and if TA decides to cancel the contract, then it must pay a cancellation penalty of 4 million Ghana cedis. TA is of view that the market may not improve in the near future.
Okay, so let's come here. Let's come to this particular one. So you can see that they are combining two issues here, isn't it?
Yes, sir.
What are the two issues that you can identify here?
Impairment and provision.
We are talking about issue of valuing inventory at the first instance, and there's another issue of what?
Of provision.
Provision relating to what? How do you call that provision?
Onerous contract.
Yeah, you can see that we have an issue of onerous contract also right here. So let's deal with the inventory first. The person, they have what? Unsold inventory of 6,000, which is valued at 500, isn't it?
Yes, sir.
But the selling price of the inventory has fallen to what?
To 350.
So it means that the net realizable value of an inventory now is how much? The net realizable value of an inventory now is how much? Per unit. Per unit. But the cost is what?
The cost is 500.
So what do we do? Inventory is measured. This inventory will be for sale. So inventory that is held for sale will be measured at what?
The lower of cost.
Okay. So what we do over here is this one. So we look at that one. So we look at the issue of the inventory, which will be IPSAS 2. Okay, they are talking about the inventory carried at a cost of, so IPSAS, okay, that will be 12. Okay, so the inventory is currently in their books at 500, but they are saying that the selling price of A has now fallen to 350. So it means that the net realizable value is now 350 per unit, and the cost is what? 500. So you have to now bring the inventory down to what? The net realizable value. So they are talking about impairment of inventory over here. Inventory is measured at lower of cost and what? Net realizable value. So we are selling this particular inventory. So we find the cost over here. So the cost of the inventory, the cost will be 6,000 multiplied by 500. What are we having?
3 million.
So that will be 3 million. Okay. The net realizable value will now be what? 6,000 multiplied by 350. What are we having? 2.1. 2 points.
1.
Okay. So we have 2.1. What will be the impairment there? What will be the inventory loss?
0.9.
So we have 0.9 million. Okay, someone can also do the loss, inventory loss will now be, someone can do 500 minus 350. That is the loss per unit multiplied by the 6,000. So the person will be getting 0.9 million. Okay, so that particular first part over there is talking about inventory measurement because they say that they have the inventory in stock and sold inventory. So the inventory is now in stock. And the inventory is valued. They are valuing the inventory at cost because inventory is valued at cost. So they are having the inventory at 500 per unit. But now the selling price of the inventory, the amount that we can receive from the selling of the inventory is now 350. So it means that the amount that we can realize from the inventory now is lower than that particular one. So we write the inventory down to what? To the net realizable value. It means that the benefit that the inventory will be given to us is now lower than the actual benefit. So we now write that particular one of 0.9 million. So that is about the what? The measurement of the inventory, about the first one. Okay. TA acquires product A. TA acquires product A. It's the same product over there, isn't it? TA acquires product A under the contract in which TA has to buy 10,000 units of product A per month for 500 per unit. The contract is still valid till what? 31 August 2019. And if TA decides to cancel the contract, then it must pay a cancellation penalty of 4 million. TA is of view that the market may not improve in near future. Okay, so if we want to complete this particular contract now, what will be the additional cost that we are going to be incurring? If we want to complete this particular contract now, what will be the additional cost that we are going to be incurring to what? To complete this particular contract?
We'll have to continue to buy the units.
And what will be the additional cost that we are going to be incurring to complete it? Okay, if I put it very simple, then it will not be a question. What will be the additional cost that the entity will be incurring to complete this particular contract per unit?
That's 1,000 cedis.
No. If you buy the unit, how much are you going to be selling it? How much are you selling product A now?
Okay, 350.
350, and you are buying it at how much?
At 500.
If you want to continue buying this one, it means that the person will be paying 350 and you will be incurring a cost of 150 to complete it, isn't it?
Yes, sir.
Yes.
So that is the cost of completing the contract. That is the cost of completing the contract. You are buying 500, but the 350 or the 500 will be recovered from the customer. It means that you are going to be incurring additional cost of 150 to complete it. Okay, so we are incurring a cost of 150 to complete the contract. So we are now asking ourselves whether we should stop or we should continue. They say the contract valued for what? Valued till what? Till 31 August.
Yes, sir.
When are we doing this? 30th June, isn't it?
Yes, sir.
So it means that we are going to be buying for July and we are going to be buying for what?
For August itself.
Okay, how many months is that?
That's 2 months.
So how many units are you going to be buying over these 2 months?
20,000.
Okay, so let's come to the additional cost of completing the contract. Okay, so you are going to be, if you want to continue with the contract, if you want to continue with the contract, let me write the onerous contract at the top here. So this will also be under IPSA 19, onerous contracts. Okay, so onerous contracts. So if you want to continue with the contract, it means that you have to continue buying the item at what, 500, isn't it? You have to continue to buy the item at 500
Yes, sir.
for the last 2 years, isn't it?
Yes, sir.
But these 500, you are going to be getting 350 from the customer. So you are going to be incurring a cost of 150 to complete. So you come over here, the additional cost of completing the contract, multiply by the remaining month that you are going to be buying. This contract is valid till 31 August. We are done with June already. So you buy from July, you buy for August. So that will give us 20,000 units. Okay, how much are we incurring?
3 million.
Okay, so we'll be incurring 3 million. Okay, but if you want to cancel the contract now, what is the penalty?
4 million.
Will you continue or you cancel?
Continue.
You continue, isn't it?
Yes, sir.
So since this particular cost will be incurred, you have an obligation to incur this particular cost. The cost can be what? Measured reliably. It is probable the amount will be going out to settle this amount. So we make provision from this one also. So you make the provision from the lowest amount or the least amount. So you make a provision of what? Of 3 million. So our total provision now will be put together. So let's have our total provision now. Total provision for the year. So I'll come here and have our total provision. We have the provision relating to the accidents. Okay. That was how much? Accident was 20 million, isn't it?
Yes, sir.
So we have 20 million. We have the redundancy, what?
Redundancy payments.
Payments was 20 million, isn't it?
Yes, sir.
Then we have the what? Onerous contract. Onerous contract to be what? To be 3 million, isn't
3
it?
million.
The inventory will go as an expense. The inventory is we don't make provision for a loss. This is a loss for the inventory. You don't make provision. So your total provision will now be 43. That will be taken to profit or loss together with the inventory as a loss. So total expense for the year will give us 43 plus 0.9 million, which is on the inventory, and that will give us 43.9 million. Okay, so that is how we go about it. So the C is actually talking about two issues over there. Valuation of inventory. They say TA had 6,000 unsold units of what product as at 30th June. Unsold means that these goods are in stock. They are in inventory, which are valued at 500. But the selling price now, the amount that we can sell it now is 350. The selling price has reduced. Why is it reducing? It is because maybe the inventory are not other good again, or there was an issue that is making the inventory to be what? To be losing its value, or the inventory is now obsolete. It can be any reason. So it's an indicator of impairment. So we find the recoverable amount of the inventory. The recoverable amount is the benefit. If we want to sell the inventory in its current condition, what is the benefit? It is going to be true sell, and that will be 350 multiplied by 6,000. How much do we have in the books? We compare the two, the lower of the what? Of the two, and we write the inventory down to the lower cost. Now, if you come to the T, if you come to the other part, the entity acquires product A under the contract in which TA has to buy 10,000 units of the product A per month for 500 units. The contract is still valid till 31 August. So 30th June, we are done with the June one. We are left with July and August. Okay, we are going to be buying these at 500 and be selling it at what? At 350. For us to complete this particular contract, we have to now go and take a certain amount of money, which is 150 per unit from somewhere, because we are going to be spending what? 500 and we are going to be getting 350. We are losing by 150. So we are going to be incurring additional cost of 150 to what? To actually complete this contract. So if you want to complete the contract in full, what is the total amount that we are going to be incurring over the next 2 months? So we do 150 multiplied by the total quantity. If we don't want to continue with the contract now, the person will now be taking action against us. And how much will the person be charging? The person will be charging 4 million. So we look at, if we want to continue with the contract, how much are we going to be needing to complete the contract? We look at that one and look at the penalty. The penalty is 4 million. The cost that we are going to be incurring to complete is 3 million. You cannot leave what? 3 million cost and go for 4 million, all things being equal. So you say, oh, I will spend less to what? To complete the contract than what? Than paying the penalty. Or the people might have other reasons for terminating, but the information we have over here is going to be based on the what? On the figures that we have. So they have to what? They have to actually what? Continue with the contract, because the cost of completing with the contract is lower than the cost of what? Terminating in present terms. Then we pick the least option and move on. All right. That is basically about what? About the provisions. Okay. That's basically about the provisions. Onerous contracts and other issues over there. Please, any issue there? So let me see. Trust, is something not clear to you?
So everything is clear.
Okay. So if there are no issues, I'll see you guys tomorrow where we look at.
Hey.
Yes, please.
So please, about the last one that we solved, when you are working, do you have to be remembering or writing the IPSAS maybe 19 and stuff?
Oh, no. Are you a law student?
You said?
Are you a law student? You don't have to do that. But I'm just putting that one so that you can actually remember something. I'm doing it as a form of maybe something you should remember. But you don't have to do that. Okay. You don't
Okay,
have to do that. All right. All right.
Okay, thank you. Bye.
Okay. All right. Just no issue. Okay. Then have a good night.